Welcome to Trading Nation. Let's talk volatility. Dennis Davitt with Harvest Volatility Management and Pravit Chintawongvanich of Macro Risk Advisors. And we'll look at the VIX. And Pravit, I know you've got a report out. We're going to get to that in just a second. Dennis, I want to start with you and ask this. And I know volatility is your game, so please do not be offended by this in any way. Given what's happened this year and given where the VIX is the VIX still a measure or a good measure of volatility? Or has it done its job? It seems to me that it's creeping toward irrelevancy, but maybe that's just me.
I wouldn't say it's creeping towards irrelevancy. I will say that, though, the VIX is the ultimate forward-looking instrument around people, how they feel about the marketplace. So if they're nervous about the marketplace, people tend to buy options. One of the things is that we need to look at is the history of the VIX, like where the options market and the products that are in the options market are now versus where they were, say, 10 years ago, versus, dare I say, 25 years ago when I first started in the business.
But that's Dennis, sorry to jump in, but that's exactly what I mean. It was not necessarily an insult to the VIX in as much as the structure of the options market has changed to the point of I just don't know if the VIX is pricing in what people are actually doing or thinking.
Well, no, it is pricing what people are doing, because what people are feeling is more comfortable in what they're doing, in how they're trading their options. And what I mean is the ability to sell options, to sell insurance into the marketplace, people are becoming more and more comfortable with that. And if you look towards technology, you can, in one button on your iPhone, download complex options order strategies at any of the major houses and then execute them through your phone, whereas 20 years ago that was not possible. So as technology advances, you know, Warren Buffett refers to derivatives as weapons of mass destruction, yet he was one of the biggest sellers of options in the marketplace all through the financial crisis. The ability to do the sort of things that Warren Buffett does, which is sell options, sell insurance at inflated prices, is now much more available to the everyday investing public, and they're taking advantage of that. You're seeing volumes go up on different exchanges like the CBOE, and the en vogue strategies right now in this low interest rate environment are strategies that sell to collect risk premium. So watching the VIX go from 16 to 9, you could almost make the argument if you were selling hurricane insurance for many, many years at a very inflated price, and now it's down at a more fair price, that, you know, is the indicator broken? Is the insurance predictor of hurricanes broken? No, it's just more and more people are getting more and more comfortable with the pricing around it. You know, I'm curious to hear Pravit's take on that.
Yeah, well, let's
think
get
it's a structure thing.
Dennis, let's get it. Okay, good enough. Kind of blowing my theory out of the water, which, hey, you're the expert in that. Pravit, I'm assuming you would agree with Dennis. Volatility is still, I don't mean volatility is still relevant. The VIX is still relevant. I know you've out a new report. You've got a couple of scenarios, really two big scenarios for the markets for next year in volatility. What are they?
So I absolutely agree with what Dennis has said about volatility in that, so the VIX is low, but what the VIX is in part measuring is people's forecasts about how much the market is going to move, how volatile the market's going to be. And the market has been very, very quiet this year. So on average, the S&P has had a daily move of 30 basis points, or less than 1/3 of 1% every day in 2017. That's extremely low volatility. So even though you're selling a low VIX, a low number, selling volatility has actually been quite profitable this year because markets have been very quiet. And so that ties into where do we see volatility going forward? Well, we think that volatility of financial assets like the S&P 500, like equities, is tied to economic conditions. And economic conditions have been pretty good this year. In other words, we've been seeing steadily improving economic conditions ever since the great financial crisis. And as economic conditions have improved, that volatility has declined, risk premiums have declined. So we see I would call it two plausible scenarios. We see, call it 75% chance that economic conditions stay the way they are, that, you know, growth continues with where it is, you know, inflation continues, you know, to stay moderately low. And in that case, you're going to see more of the same next year. You're going to see continued low volatility, pretty low average VIX. I mean, this year the VIX averaged 11. I think that sounds about in the ballpark for 2018, assuming that economic conditions stay the same. And then call a 25% chance that economic conditions worsen. So either inflation spirals out of control or increases higher than people are expecting it to, or growth takes a hit, possibly because either central banks are too aggressive in tightening, or possibly some other reason that causes growth to fall off.
For two things. First off, you guys told me I'm wrong in the nicest possible way, which I really appreciate. We need more of that type of professional decorum in this day and age, because all we seem to talk about in news and what we hear about is, oh, there's problems here and there's volatility, there's fear here, North Korea, blah, 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 blah. What it sounds like you're saying is really now more than ever, you've got to separate the hype, right? What we hear about, the screaming, the sort of the caps lock, the loud voices, from what's really happening underlying in the market, Pravit. Is that a fair way to say it?
I think that's an absolutely fair way to call things. And, I'm not saying that the VIX is never going to spike next year. I think it could absolutely spike, and I think it could, possibly be off some geopolitical event, or maybe markets just sell off for no reason. We all know markets can do that sometimes, although it hasn't happened for a while. But say the Brexit last year, for example, we got a moderate spike in volatility, but I think it reverted so quickly because it came against the backdrop of fundamentally strong economic conditions. If the Brexit had happened in, say, 2011 or 2010, I think the financial fallout would have been much worse.
And Dennis, maybe that's my problem. Maybe I'm too close to it. Doing what I do for a living, you can't avoid all the noise because that is part of the cycle. But it sounds like that's what we have to do, and the VIX maybe is underlying measuring that underlying calmness.
Yeah, I mean, and one of the things you need to look to that not a lot of people talk about is the lack of leverage that's in the marketplace right now. Whereas pre the financial crisis, you had investment banks with very large positions that were very levered in those short volatility positions. So if the VIX started going higher, they started losing money in outstripped fashion. So levered, I'm talking about 60-to-1 leverage, where now it just doesn't exist anymore. And it goes back to technology where it's spread out to so many more people with so little leverage. I mean, people bet more money on the Super Bowl more than likely in their portfolio than they do, in a short volatility position. Now, there are some ETFs in the market. That's the one thing I would look at. There's a great deal of uncertainty, in my opinion, about these exchange-traded, these ETPs that are double and triple levered around short volatility positions, where they haven't been tested because they all came about after the financial crisis. So if there's a way, if there's something out there in the future lurking in the shadows, I would say it's the multiple levered ETFs that are in the marketplace right now that people don't truly understand.
Yeah, that's a different segment on Trading Nation, because I completely agree with you on that one. ETFs are skewing the market in a certain way. We got to see how it all ends up. Anyways, a very, very good discussion, guys, on volatility or the lack thereof. Pravit, Dennis, thank you both very much. Folks, as always, love to hear from you. Check us out on Twitter and social media. I'm Brian Sullivan. See you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.